As you have seen, what is taxable under general is not the same as what is taxable under life. And again, when it comes to expenses, again we have a variance. So we are not supposed to combine, meaning we are supposed to calculate the taxable profit separately. Then thereafter we calculate the tax liability. In order for us to understand this well, we can have one question so that at least we can understand that concept better. The question that we are going to consider is from our past paper, that is June 2013, and the question is number 5. So it is about Bima Insurance Company Limited. So the question reads like this: Bima Insurance Company Limited provided the following details with respect to the transactions for the financial year ended that 1st December year 2012. So we have bad debts, we have investment income, reserve for unexpired risks, commission on reinsurance acceptance, we have claims outstanding as at start, we have gross premiums, claims paid, claims outstanding as at the end, claims recovered on reinsurance, legal expenses relating to claims, commission on reinsurance cedent, we have agency fees, foreign exchange losses, dividend from life assurance fund, management fees, bonus utilized in reduction of a premium, royalties from patents, repair of rented premises, traveling expenses, purchase of motor vehicles, reinsurance commission paid, return premium, and rental income. Additional notes: agency fee of 16,400,000 relate to life insurance arm of the company. Management fee included 24,200,000 relating to tax consultancy. Then repairs of rented premises include 14,800,000 incurred on purchase of furniture. So you are required to prepare a statement of the adjusted taxable profit of Bima Insurance Company Limited for the year. So we can calculate that as follows. So we have a solution. So we have said the question is in this June 2013 5A. June 2013 question 5A. So we have Bima Insurance Company Limited. We have computation of taxable profit for the year ended that 1st December 2012. So we have particulars and we have shillings here. So this is general insurance business. So we will capture the taxable incomes of the general. And as we said, one of the major income is net premiums. And in my question, I have a gross premium of 24,648,600. So the gross premium is, we have 24,648, 600. We have an adjustment because like in our question we have reinsurance premium that was paid. This is a premium that was received but it was paid to the other insurance company. So it's not a taxable income here. We are supposed to less that, which is 724,800. And again also we have returned premium. This is premium that was returned to the policyholder, so meaning it is also not part of the taxable income, which is 1314,600. 1314,600. So the taxable income now will be, we have 24,648 600 minus 724 800 minus 1314 600. So we have 22 609 200. Then the other taxable income that I can see is claims recovered. That is reinsurance recoveries. Reinsurance recoveries. This reinsurance recoveries is 545,700. 545,700. The other taxable income is reinsurance commission cedent. Commission cedent, and this is 728,900. The other taxable income is bonus utilized in reduction of premium. Bonus utilized in reduction of a premium, which is 371 700. The other taxable income of this insurance business is reserve for unexpired risk. So the reserve for unexpired risk we are given as at start and we don't have as at the end. That means it reduced to zero, and therefore it constitutes to be a taxable income. So decrease in reserve. Decrease in reserve, and this decrease in reserve is 948,600. 948,600. 948,600. So let me check whether we have any other taxable operating income. No, so we don't have any other taxable operating income. So we need to get the total, that is gross taxable operating income. Gross taxable operating income, we have 22,609 200 plus 545 700 plus 728 900 plus 371 700 plus 948 600. So you get 25 204 100. Then we less allowable cost, less allowable expenses. We less allowable expenses, and the allowable expenses we have in our question. Number one, I can see bad debts. Bad debts. And the bad debts is 468. 468. Then the other one is commission accepted. The insurance commission accepted. The insurance commission accepted, and this reinsurance commission accepted is 3,484,900. 484,900. 3,484,900. Then from there we have claims, and for the claims we have adjustment. The claim paid is 48,26,000, 1,000. We minimize those zeros. Then we have claims outstanding as at the end, so that one we add. So we add 1850. Then we less claims outstanding as at start, which is 676.2. 676.2. So the net claims for the year will be 48,26,000 minus 1850,000 minus 676,200. So we have 299,800. Then the other allowable cost we have is legal expenses relating to claim. Legal expenses, and legal expenses, we do not have a note also. That is 376,700. 376,700. Then the other expense is agency fee. Agency fees. And for the agency fees, we have a note. Note number 1. Agency fee of 16,400 relate to life assurance arm of the company. So we are not taxing life, we are taxing general. So that one should not be subtracted here. So we are supposed to take the gross, which is 1296,400, 1296.4 minus 1296.4 minus 16,400. 16,400. So the agency commission will be 1296, 400. That is 96, and this is 400. So we take 1296, 400 minus 16,400. So you get 1280. Then the other allowable cost, we have foreign exchange loss. Foreign exchange loss is only allowable if it is realized. If it is not realized, it is not deductible. Then we have management fees. Fees. And for the management fees, again we have a note. So management fee is 1,804,600, but we hint at the number 2. It includes 24,200 paid to a tax consultancy company. Tax consultancy is not allowable. So you are supposed to take management fee 18,04,600, 18,04,600 minus 24,200, 24,200 minus 24,200. So you get 17,80,400. 17,80,400. Then the other allowable cost is traveling expenses. Traveling expenses. And the traveling expenses is 89,400. 89,400. The other allowable cost that we have is here. We have bought a motor vehicle, and for this motor vehicle we have WTA. So WTA, we enter allowance on motor vehicle, and motor vehicle we calculate we enter at a rate of 25%. So 25% times 800. So that will be 200.25 times 800. You get, yes, 200. Then any other allowable cost? We don't have any other allowable cost, any other allowable expense. So we have exhausted the allowable. So we get the total. So the total of the expenses, we have 468,000 plus 3,484,900 plus 2,299,800 plus 376,700 plus 12,80,000 plus 17,80,400 plus 89,400 plus 200,000. So sorry, 468,000 plus 3,484,900 plus 2,299,800 plus 376,700 plus 12,80,000 plus 17,80,400 plus 89,400 plus 200,000. You get 9,979,200. So you raise this, you get 25 gross. You raise these expenses, you get taxable operating profit, taxable operating profit or loss. In our case, 25 is more, so it is a taxable profit. So to take 25, 204 100 minus 9,979,200, you get 15, 224,900. Then this is the profit that this insurance company is getting from its operating activities. So you need to add taxable investment income. You add taxable investment income, taxable investment incomes. And in our question, we have taxable investments such as we have rental income, and for the rental income we don't tax the gross, we tax the net. And in our question we have the repairs of the rented premises. So we are supposed to take the gross rent, which is 560,000. We less expenses, the allowable expenses, such as we have repairs, and these repairs are 264,800. You less that. Then there is a note number 3. Repairs of rented premises include 18,800 incurred on purchase of furniture. So these repairs is including cost of non-current asset. Cost of non-current asset is not allowable, and therefore I need to add back that cost of furniture. And back furniture, and the cost of the furniture is 14,800. When you add back these furnitures, they are subject to wear and tear. So its cost is not allowable, but what is allowable is its wear and tear. So I'm supposed now to raise its wear and tear. I raise WTA on furniture. and this is calculated at 12.5%. So 12.5% you multiply by 14,800. 12.5%. So 0.125 you multiply by 14,800. So you get 1815. 1815. So net rental income will be equal to 560,000 minus 264, 800 minus plus 14,800 minus 1815. So you are going to get 308,150. 308,150. 560 minus 264, 800 minus 1850 plus 14,800. So get 308,150. And the last income again that I can see is royalty income. We also have royalty from patents. Royalty income. And this royalty income is 1460. 1460. So those are the, again also we have another investment income. Investment income of 960. 960. So these are the only incomes that we have in our question. So we can now get the total taxable income for the year. Total taxable income for the year. This is equal to, now we have 15,224,900 plus 308,150 plus 1460,000 plus 960. So in total we have 17,953,050. So that is the gross taxable income for the year. If somebody now want to get the tax liability, gross tax, you get 30% times 17,953,050. So times 30%. So you get 5,385,915. So that is the net tax, that is the tax liability, and also the gross taxable, the taxable income for the year. So learners, that comes to the end of our session, and it is my hope that you have understood how we deal with the insurance companies, what is taxable, and again what is not taxable. So thank you very much, and welcome in the next lesson. Thank you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.